A 2020 São Paulo School of Economics study tracked 19,646 individuals attempting to day trade Brazilian mini-index futures. Only those persisting more than 300 trading days entered the sample. 97% lost money. 1% earned above the Brazilian minimum wage. 3 individuals cleared the salary of a bank teller. The natural explanations fail. Skill, education, and starting capital do not sort the outcomes. The distribution is not behavioral. It is defined by 4 multiplicative constants imposed by the market structure. 4 theorems formalize the retail-to-institutional asymmetry. Kyle, 1985. Price impact scales linearly with order flow, and the slope, lambda, is set by the ratio of informed to uninformed volume. The uninformed side pays the informed side through the tape. Gloston and Milgram, 1985. A market maker quoting a bid-ask spread cannot distinguish informed from uninformed counterparties on any single order. The equilibrium spread widens to a size that recovers expected losses from informed flow. The maker's entire profit derives from uninformed flow. Grinold, 1989, The Fundamental Law of Active Management. Information ratio equals information coefficient times the square root of breadth. Skill compounds with the number of independent bets, not the size of any single bet. Parold, 1988, Implementation Shortfall. The true cost of a trade is not the commission on the ticket. It is the difference between the price at the moment of decision and the realized fill after all frictions have taken their cut. 4 theorems, 4 constants. Each one describes a channel through which retail structurally loses ground to the institutional side before any question of skill enters the calculation. Kyle's lambda and the Gloston-Milgram spread are not abstractions. They are engineered into the physical layer of the market. Citadel Securities, Verdu, Jump Trading, and DRW lease colocation racks inside the same buildings as the matching engines. NYSE at Mahwah, Nasdaq at Carteret, CME at Aurora, Illinois. Round-trip latency between co-located rack and matching engine is measured in hundreds of nanoseconds. A retail order routed through a payment for order flow wholesaler takes a median 20 to 40 milliseconds to reach an executing venue. The gap is 5 orders of magnitude. Within that gap, the wholesaler observes the national best bid and offer, the exchange native order book, and its own internalized retail flow, and quotes against the retail order already knowing where it sits in the queue. Payment for order flow dollarizes this asymmetry directly. In Rule 606 disclosures for the first quarter of 2021 alone, Robinhood reported approximately $142 million in payments from Citadel Securities, out of a quarterly total of $331 million. That number is not compensation for a service. It is the wholesaler's ex-ante estimate of the adverse selection premium it earns against retail flow times expected retail volume discounted to present. Retail is not the customer of this arrangement. Retail is the product. Grinold's fundamental law and Parold's implementation shortfall convert into portfolio geometry and transaction friction. Assume 2 operators forecast at an information coefficient of 0, 0.5, modest, honest signal. Neither is a genius. The discretionary retail trader holds 4 concentrated positions per year. Their information ratio equals 0, 0.5 times the square root of 4, which is 0, 10. The market-neutral quantitative fund holds 400 independent bets per year. Their information ratio equals 0, 0.5 times the square root of 400, which is 1, 0, 0. Same signal, same skill. A tenfold risk-adjusted return differential from portfolio geometry alone. The transaction stack compounds the geometry. On a retail equity trade, the visible commission is 0. The invisible layers decompose as follows. Effective spread paid to the internalizer, 3 to 12 basis points, size adjusted. Price improvement foregone against the lit exchange midpoint, 1 to 4 basis points. Retail margin financing, 11 to 13% annualized. Institutional prime brokerage financing on the identical position, SOFR plus 30 to 80 basis points. The spread between retail and institutional cost is roughly 700 basis points, compounding daily on any leveraged carry and never surfaced on the platform interface. Four constants: latency, adverse selection, breadth, cost stack. They do not add, they multiply. A 1% edge lost on each channel compounds to roughly a 4% annual drag on realized return before any behavioral error enters the calculation. A perfectly disciplined retail trader with zero leverage, zero emotion, and honest signal still faces the same four constants. The 97% figure is not a failure of individual traders. It is the equilibrium output of the market's microstructure operating exactly as it was designed to. The next video isolates the first two constants tick by tick inside the limit order book and shows how a quantitative desk reads adverse selection in real time.